How did Enron's complex entities hide its financial fraud? Imagine a company so tangled in its own financial web that it becomes nearly impossible to see what's real and what's not. That's exactly what happened with Enron. The company used a network of special purpose entities, or SPAs, to hide its debts and inflate its profits. These SPAs are separate legal companies created for specific tasks, often to limit financial risk. Enron exploited this by transferring underperforming assets and debt to these entities. The trick was that Enron made sure these SPAs looked independent. They kept outside investors holding only a small stake, so Enron could avoid consolidating these entities into its own financial statements. This meant the debts and losses of the SPAs stayed hidden from the main company's books. Two well-known examples are Yadai and Chuko. Enron transferred assets and debt to these entities, which borrowed money guaranteed by Enron's stock. Since the SPAs relied heavily on Enron's stock price, they looked healthy as long as the stock stayed high. When the stock price dropped, the whole setup started to fall apart. Enron also used a method called mark-to-model accounting. This allowed them to record projected profits from long-term contracts as if they had already earned the money. Instead of waiting for actual cash, they booked these future earnings immediately. This made their profits look much bigger than they really were and hid any losses. The company's chief financial officer, Andrew Fastow, managed many of these SPAs. He personally profited from these entities while orchestrating transactions that made him money and hid Enron's true debt. The board of directors let him do this by ignoring conflict of interest rules. This created a situation where Fastow's personal gains were tied directly to the company's false financial reports. All of these complex structures and accounting tricks made Enron's financial health look much better than it really was. Investors, analysts, and regulators were misled into thinking the company was doing great. In reality, Enron was hiding billions of dollars in debt and overstating its profits. When the truth finally came out, Enron collapsed in one of the biggest corporate failures in history. This case shows how financial innovation can be dangerous when misused. It highlights the importance of transparency, strong corporate governance, and careful auditing to prevent companies from hiding the truth. The Enron scandal remains a powerful lesson about the risks of overly complicated financial schemes and the need for honesty in business.